Everyone thinks the Federal Reserve pausing interest rate hikes is good news. The stock market rallies when the Fed signals they're done raising rates. Investors celebrate. Business leaders breathe a sigh of relief. The financial media talks about a soft landing. Everyone's acting like we just dodged a bullet. But I'm going to tell you something that most people don't understand. The Fed pausing rate hikes right now might be the most dangerous thing they could do. And it could trigger a crash that makes 2008 look tame. I know that sounds counterintuitive. I know it goes against everything you're hearing from Wall Street and the financial press. But let me explain exactly why the Fed pause is a trap, why it creates conditions for a catastrophic market crash, and why the very thing everyone is hoping for might be what destroys their portfolios. I'm Michael Burry. I made my name and my fortune by seeing what others couldn't see, by doing the work when everyone else was taking the easy path, by being right when the consensus was wrong. In 2005 and 2006, everyone said the housing market was strong. Everyone said subprime mortgages were safe. Everyone said the banks had hedged their risks. Everyone told me I was an idiot for betting against the housing market. I read the loan documents. I spent months analyzing mortgage after mortgage. I looked at the actual credit quality of borrowers. I analyzed the data that everyone else was ignoring. I saw that the mortgages were garbage, that the housing market was a bubble built on fraud and fantasy, and that the financial system was built on sand. And I bet billions against it. I paid premiums on credit default swaps month after month while everyone told me I was wrong. My investors questioned me. They wanted to pull their money out. The banks sent representatives to my office to explain why I didn't understand modern risk management. The rating agencies insisted their models were sound. And then the crash came in 2007 and 2008. Everything I predicted happened. The mortgages defaulted. The securities became worthless. Bear Stearns collapsed. Lehman Brothers collapsed. The entire financial system nearly went down. I made over 700% returns for my investors while the rest of the world lost trillions. I was right because I ignored the noise and focused on reality. I didn't care what the consensus believed. I cared what the data showed. And right now, reality is telling me that the Federal Reserve is about to make a catastrophic mistake. They're about to pause interest rate hikes at exactly the wrong time. And when they do, they're going to unleash consequences they don't understand and can't control. Let me start by explaining what the Fed is actually trying to accomplish. Because most people don't really understand what the Federal Reserve does or how monetary policy works. And if you don't understand the mechanism, you can't see where it's going to break. The Fed has a dual mandate. They're supposed to maintain stable prices and maximize employment. In practice, this means they try to keep inflation around 2% and keep unemployment low. That's the theory. The reality is much messier. When inflation is too high, they raise interest rates. Higher rates make borrowing more expensive. That slows down economic activity. People and businesses borrow less. They spend less. Demand falls. And when demand falls, prices stop rising so fast. That's how you fight inflation. You make money more expensive. You reduce the amount of money chasing goods and services, and prices stabilize. When unemployment is too high and the economy is weak, they lower interest rates. Lower rates make borrowing cheaper. People and businesses borrow more. They spend more. Demand increases. Companies hire more workers to meet that demand. That's how you stimulate the economy. You make money cheap. You encourage spending and investment. Simple in theory, much harder in practice. Because raising rates to fight inflation can cause a recession, and lowering rates to fight unemployment can cause inflation. The Fed is always trying to balance these competing pressures. They're always trying to find the right level of interest rates that keeps inflation under control without crashing the economy. This is what they call threading the needle. And historically, they're terrible at it. For the past 2 years, the Fed has been in inflation fighting mode. They raised interest rates from 0% to over 5%. That's one of the fastest rate hiking cycles in history. They moved rates higher faster than almost any time in the past 40 years. They did this because inflation got completely out of control. It reached over 9% in the summer of 2022. That's the highest inflation in over 40 years. Food prices were soaring. Gas prices hit record highs. Rent increases were crushing people. The cost of everything from cars to furniture to electronics was going through the roof. The Fed was way behind the curve. They should have started raising rates in 2021 when it was obvious that inflation was getting hot. But they didn't. They insisted that inflation was transitory. They said it would go away on its own once supply chains normalized and people stopped spending their COVID stimulus checks. They were wrong. Catastrophically wrong. I was saying in 2021 that inflation wasn't transitory. I was pointing out that you can't shut down the global economy, print trillions of dollars, and not have inflation. It's basic economics. But the Fed ignored it. They kept saying transitory. They kept rates at zero. They kept buying bonds through quantitative easing. They kept pumping liquidity into the system even as inflation was clearly accelerating. So they had to play catch-up. They had to raise rates aggressively to make up for lost time. They had to convince markets and the public that they were serious about fighting inflation after spending a year saying there was no problem. And now, inflation has come down. It's around 3 to 4%, depending on which measure you use. That's much better than 9%, but it's still above the Fed's 2% target. It's still double where they want it to be. And this is where we are today. The Fed has paused rate hikes. They're holding rates steady around 5 to 5.25%. They're watching the data. They're trying to figure out if they've done enough to bring inflation back to 2% without causing too much economic damage. And the market is celebrating. Investors think the worst is over. They think the Fed is done raising rates. They think we're going to have a soft landing where inflation comes down and the economy stays strong. Stock prices have rallied. Corporate bond spreads have tightened. The consensus is that we dodged a recession and everything will be fine. But I think they're catastrophically wrong. And I'm going to explain exactly why. Let me tell you why the Fed pause is so dangerous. And I'm going to go through this methodically because each piece builds on the others to create a scenario that could destroy wealth on a scale we haven't seen since the Great Depression. First, inflation is not actually under control. Yes, it's come down from 9%. That's good. But it's still double the Fed's target. And more importantly, the underlying drivers of inflation haven't gone away. They're structural. They're not going to disappear just because the Fed raised rates for a year. The labor market is still very tight. Unemployment is around 3.7%. That's near historic lows. And the labor force participation rate hasn't fully recovered from COVID. We have millions fewer people working or looking for work compared to pre-pandemic levels. When unemployment is that low and labor supply is constrained, workers have enormous bargaining power. They can demand higher wages. They can switch jobs for better pay. Companies have to compete for workers. And when wages rise, businesses pass those costs on to consumers in the form of higher prices. That's wage price inflation. And it's very difficult to break once it gets started. Because workers aren't going to accept pay cuts. Once they've gotten used to higher wages, they build that into their lifestyle. They commit to higher rents or mortgages. They increase their spending. Asking them to take lower wages would require a severe recession with massive job losses. That's the only way to break wage price inflation. You have to destroy demand for labor. The Fed knows this. That's why Paul Volcker had to push unemployment over 10% in the early 1980s to break inflation. It was brutal, but it was necessary. The current Fed doesn't have the stomach for that fight. We also have structural inflation from deglobalization. For 30 years, globalization kept prices down. Companies could manufacture goods in China where labor was cheap. They could source materials from wherever was cheapest. Supply chains were optimized for cost efficiency. Goods got cheaper every year because of globalization. That era is over. We're now in an era of friendshoring and reshoring. Companies are moving manufacturing back to the United States or to allied countries. Why? Because COVID exposed how fragile those supply chains were. Because geopolitical tensions with China have made companies nervous about depending on China for critical goods. Because governments are subsidizing domestic manufacturing for strategic industries like semiconductors and batteries. This is good for national security and resilience, but it's more expensive. Manufacturing in the United States costs more than manufacturing in China. Supply chains that prioritize resilience over cost are more expensive. All of this is inflationary. We're also seeing massive government spending on infrastructure, on green energy transition, on semiconductor manufacturing. The CHIPS Act alone is spending over $50 billion to subsidize semiconductor fabs in the United States. The Inflation Reduction Act is spending hundreds of billions on green energy. The infrastructure bill is spending over $1 trillion. All of this spending is inflationary. It's putting more money into the economy competing for limited resources. It's bidding up the prices of construction materials, labor, equipment, and this spending is going to continue for years. And we have energy inflation. The transition away from fossil fuels is happening, but it's happening slowly and chaotically. We're underinvesting in traditional energy. Oil companies are reluctant to invest in new drilling because of ESG pressure and uncertainty about long-term demand. We're seeing chronic underinvestment in oil and gas production. At the same time, renewable energy isn't yet ready to fully replace fossil fuels. Solar and wind are intermittent. Battery storage is expensive and limited. The grid infrastructure needed to support renewable energy doesn't exist yet. This creates energy supply constraints. And when energy is expensive, everything is expensive because energy is an input into everything. Manufacturing needs energy. Transportation needs energy. Agriculture needs energy. When oil and gas prices are elevated, it feeds through to the entire economy. All of these factors mean that inflation is likely to be much stickier than the Fed expects. It's not just going to drift down to 2% on its own. It's not transitory. It's structural. It's going to require sustained, tight monetary policy to bring it under control. It's going to require interest rates to stay high for longer. Maybe much longer. Maybe years. But the Fed is pausing. They're taking their foot off the brake. They're signaling to markets that they think they've done enough. And when inflation doesn't continue falling, when it stalls out at 3 or 3.5%, when it maybe even starts rising again, they're going to be shocked. They're going to realize they paused too soon. They're going to realize they declared victory prematurely. And they're going to have to restart rate hikes. This is the worst possible scenario. Because markets have already priced in the idea that the Fed is done hiking. Stock prices have rallied based on that assumption. Companies have issued new debt based on the assumption that rates won't go higher. Business plans have been made assuming financing costs are stable or coming down. If the Fed has to restart rate hikes after pausing, it will shatter confidence. It will show that the Fed doesn't actually have inflation under control. It will show that they made a mistake by pausing. It will show that they're reactive rather than in control. And markets will reprice violently. Stock prices will crash. Bond prices will crash. Corporate bond spreads will blow out. Credit will freeze up. And the Fed will be right back where they were, except now they've lost credibility. This happened before. In the 1970s. This is not theoretical. This is exactly what happened 45 years ago. And we're repeating the same mistakes. In the early 1970s, inflation started rising. The Fed under Arthur Burns raised rates. Inflation came down a bit. The Fed declared victory and paused. They even started cutting rates. And then inflation came roaring back, even worse than before. It went from 4% to over 6% to over 10%. It kept accelerating. The Fed would raise rates, pause, cut rates, and inflation would accelerate again. This went on for a decade. It wasn't until Paul Volcker took over as Fed chair in 1979 that someone finally had the courage to break inflation's back. Volcker raised rates all the way to 20%. 20%. He kept them there despite enormous political pressure, despite a severe recession, despite unemployment reaching over 10%. He didn't care. He was committed to killing inflation, and it worked. But the cost was enormous. We had back-to-back recessions. Millions of people lost their jobs. Entire industries were devastated. The savings and loan industry collapsed. It was brutal. And we could be heading for a repeat. Because the Fed is making the same mistake Arthur Burns made. They're assuming that inflation will continue falling without continued pressure. They're assuming that their rate hikes have done enough. They're declaring victory before the war is won. But they're basing this on hope, not on evidence. They're basing it on wishful thinking. They're basing it on political pressure to stop hurting the economy and the markets. And when inflation proves to be stickier than they expect, they'll either have to admit their mistake and restart rate hikes destroying their credibility. Or they'll stick with the pause and let inflation become entrenched, requiring an even more painful response later. Either way, it ends badly. Second, and this is critical, the lag effects of monetary policy haven't fully hit yet. This is something most investors don't understand. They think that when the Fed raises rates, the impact is immediate. It's not. There's a significant lag between when rates are raised and when the economic impact is felt. When the Fed raises interest rates, it doesn't impact the economy immediately. There's a lag. Economists estimate it takes 12 to 18 months for rate hikes to fully work their way through the economy. Some estimates go even longer, up to 2 years. Why is there a lag? Because most debt is fixed rate and long-term. If you have a 30-year mortgage at 3% that you took out in 2021, the Fed raising rates to 5% doesn't affect you today. Your payment doesn't change. You're locked in at 3% for 30 years. The higher rates don't matter to you. Same with businesses. If you issued bonds at low rates in 2020 or 2021, those rates are locked in for 5 years or 10 years or even 30 years. The higher rates today don't affect your existing debt. Your interest expense doesn't change. You don't feel any pain from the rate hikes. But eventually debt matures. Eventually people need to refinance. Eventually new borrowers come into the market and have to pay the new higher rates. That's when the rate hikes bite. That's when the economic impact is felt. And we're just starting to see this happen. The Fed started raising rates aggressively in early 2022. If the lag is 12 to 18 months, the full impact won't be felt until mid to late 2023 at the earliest. And more realistically, into 2024 and 2025, commercial real estate is a perfect example. This is where I'm seeing the most stress right now, and it's going to get much worse. Office buildings, retail properties, apartment complexes, most of this was financed with loans that are now coming due. These loans were taken out when interest rates were near zero. 5-year loans originated in 2018 or 2019 at 3% or less. Those are maturing now. They need to be refinanced at 5 or 6 or 7%. In many cases, the properties can't support that higher debt service. Let me give you a specific example. An office building in a major city was purchased in 2019 for $50 million with a loan at 3% interest. The annual interest expense was $1.5 million. The building generated $2 million in net operating income, so there was $500,000 of cash flow after debt service. Everyone was happy. Now that loan is maturing. The building needs to be refinanced, but interest rates are now 6%. On a $50 million loan, that's $3 million in annual interest expense. But the building is still only generating $2 million in net operating income. Actually, it's generating less because vacancy rates have gone up due to work from home. Maybe it's only generating $1.5 million now. So the owner can't refinance at the current rates. The debt service would exceed the property's income. The owner has 3 choices. Put in more equity to reduce the loan size. Try to find a lender willing to lend at lower rates, which doesn't exist. Or default and give the keys back to the bank. Most are choosing option 3. They're defaulting. They're walking away, and the banks are stuck with properties worth far less than the loans. Because property values have fallen too. When interest rates go from 3% to 6%, property values fall dramatically. Real estate is valued based on cap rates, which move with interest rates. If cap rates double, property values get cut in half. That $50 million building might only be worth $30 million now. So the bank has a $50 million loan secured by a $30 million property. That's a $20 million loss for the bank, and this is happening across the entire commercial real estate sector. We're seeing this play out in real time. Office property sales in major cities are happening at prices 40 to 60% below peak values. Banks are starting to report losses on their commercial real estate portfolios. Some regional banks have significant exposure to this. 10 or 20 or 30% of their loan portfolios are commercial real estate. They're going to take massive losses, but it's just the beginning. There are trillions of dollars in commercial real estate debt that will need to be refinanced over the next 3 years. A huge wave of maturities is coming in 2024 and 2025 and 2026. Much of it won't be able to handle the higher rates. We're going to see a wave of defaults. Banks are going to take hundreds of billions of dollars in losses. Some banks will fail. We already saw this with Silicon Valley Bank and First Republic and Signature Bank in early 2023. Those failures were partly due to bond losses, but also due to exposure to troubled sectors including commercial real estate. And this will create stress in the financial system. When banks take losses, they have to reduce lending. They have to meet capital requirements. So they pull back. They tighten lending standards. They reduce exposure to risky sectors. This creates a credit crunch. And credit crunches cause recessions. The same dynamic applies to corporate debt. Companies borrowed heavily when rates were low. Corporate debt in the United States is over $11 trillion. Much of that was issued at very low rates during the 2020 and 2021 period when rates were zero. Now that debt is maturing over the next several years. They need to refinance at much higher rates. Some companies can handle it. They have strong cash flows. They generate enough profit to absorb the higher interest expense. They'll be fine. But many companies, especially highly leveraged companies, zombie companies that were barely surviving even at low rates, they're not going to make it. They're going to default. They're going to go bankrupt. We're already seeing this. Corporate bankruptcies have been rising. High-profile companies like Bed Bath & Beyond, Tupperware, Party City, Vice Media have gone bankrupt. These are just the beginning. We're going to see many more. And when companies go bankrupt, it destroys wealth. Equity holders get wiped out, bond holders take losses, banks that lent to these companies take losses, suppliers lose customers, workers lose jobs. It ripples through the economy. This hasn't fully played out yet because the debt maturities are spread over several years. But it's coming. It's baked into the cake. The Fed's rate hikes from 2022 and 2023 are going to cause economic damage in 2024, 2025, and 2026. The bombs have been dropped, but they haven't all exploded yet. And if the Fed pauses now, if they stop raising rates just as these lag effects are starting to hit, they're going to misread the situation. They're going to see the economy slowing. They're going to see unemployment rising. They're going to see companies defaulting and banks taking losses. And they might panic. They might think they went too far. They might start cutting rates prematurely to try to save the economy. This would be a disaster. Because if they cut rates before inflation is truly under control, before they've broken the back of wage price inflation, before they've re-anchored inflation expectations, inflation will accelerate again. They'll reignite it. And then they'll be stuck. They'll have an economy that's weakening with rising inflation. That's stagflation. That's the worst of both worlds. High unemployment and high inflation at the same time. And there's no good policy response to stagflation. If you raise rates to fight inflation, you make the recession worse. You destroy more jobs. If you cut rates to fight the recession, you make inflation worse. You create more price increases. You're damned if you do and damned if you don't. This is the nightmare scenario. And the Fed is walking right into it by pausing too soon. Third, the Fed pause creates moral hazard and encourages bad behavior in financial markets. Let me explain what moral hazard means. When the Fed signals that they're done raising rates, when they signal that they're ready to cut rates at the first sign of economic trouble, it tells investors and businesses that the Fed has their back. It tells them that the Fed will protect them from losses. It tells them that risk is subsidized, that they don't need to be prudent, that they can take on leverage and make speculative bets because the Fed will bail them out if things go wrong. This distorts decision-making. It encourages excessive risk-taking. It creates bubbles. This is exactly what happened after the 2008 financial crisis. The Fed cut rates to zero. They kept them there for 7 years. 7 years of zero interest rates. They bought trillions of dollars in bonds through quantitative easing. They flooded the system with liquidity. There was more money than there were safe places to put it. And what did investors do? They took enormous risks. They had no choice. They needed returns. They bought stocks at inflated valuations. They bought junk bonds from weak companies. They funded unprofitable startups. They invested in cryptocurrencies that had no underlying value. They invested in meme stocks based on social media hype. They piled into SPACs, special purpose acquisition companies, which were just blank check companies with no business. They did this because they knew the Fed would support asset prices. They knew that any time markets started to fall, any time there was even a hint of trouble, the Fed would step in with more stimulus, more rate cuts, more bond buying, more liquidity. This became known as the Fed put. The idea that the Fed would always put a floor under asset prices, like a put option in the stock market. It created a massive moral hazard. It encouraged speculation. It divorced asset prices from underlying fundamentals. Companies with no profits, no path to profitability, no viable business model, they were valued at billions or tens of billions of dollars. Why? Because the Fed made it so easy to borrow money that people would throw money at anything, and it created enormous bubbles. A bubble in stocks, a bubble in bonds, a bubble in private equity valuations, a bubble in venture capital valuations, a bubble in real estate, a bubble in cryptocurrency, a bubble in everything. When COVID hit in 2020, the Fed went even further. They cut rates back to zero within weeks. They started buying bonds again at an unprecedented scale. They bought not just treasuries, but also corporate bonds. They even started buying junk bond ETFs. They were directly supporting the prices of risky corporate debt. The message was clear. We will not let asset prices fall. We will not let markets correct. We will do whatever it takes to prop up asset prices. We will bail out everyone. And markets went crazy. In the middle of a pandemic, in the middle of the worst economic collapse since the Great Depression, with unemployment hitting 14%, with GDP falling at an annualized rate of 33% in the second quarter of 2020, stock prices went to all-time highs. It made no sense. The economy was in shambles, but the stock market was soaring. Unless you understood that the Fed was forcing investors into risky assets by making safe assets yield nothing. If bonds yield zero, if cash yields zero, investors have to chase risk to get any return. They have to buy stocks, they have to buy junk bonds, they have to buy crypto. There's no alternative. Now, the Fed finally started raising rates in 2022 to fight inflation. And asset prices started to come down. Stocks fell. The S&P 500 dropped over 20%. The Nasdaq dropped over 30%. Bonds fell. Long-duration treasuries fell over 30%. The worst year for bonds in history. Crypto collapsed. Bitcoin fell from 69,000 to 16,000. Ethereum fell from 4,800 to 900. Many cryptocurrencies lost 90% or more of their value. Unprofitable tech companies got crushed. Companies that had been valued at billions based on hype and growth stories saw their valuations collapse. Some lost 70 or 80 or 90% of their value. This was healthy. This was markets returning to reality. This was overvalued assets, getting repriced to reflect actual fundamentals and higher interest rates. This is what should have happened years earlier if the Fed hadn't artificially suppressed interest rates for so long. But it was painful. A lot of people lost a lot of money. Wealth was destroyed. Retirement accounts shrank. People who had thought they were financial geniuses because they made money in a bubble realized they were just riding a wave created by Fed policy. And now there's enormous pressure on the Fed to stop the pain, to pause rate hikes, to signal that cuts are coming soon, to restart the music so the party can continue. If the Fed gives in to this pressure, if they pause before they should, if they restart the cycle of easy money, they're going to restart the cycle of moral hazard. Investors will interpret the pause as a signal that the Fed is ready to start supporting asset prices again. They'll think the coast is clear. They'll think the Fed put is back. They'll start taking risks again. They'll start speculating again. They'll lever up. They'll buy overvalued assets expecting them to go higher. And we'll blow another bubble. Except this time, we'll be doing it with inflation still above target. With structural inflationary pressures still in place. With the memory of 9% inflation still fresh. And when that bubble bursts, and it will burst because all bubbles burst, the Fed won't be able to respond the same way they did before. They won't be able to cut rates to zero because inflation will still be elevated. They won't be able to do massive quantitative easing because that would pour gasoline on inflation. They'll be stuck between a crashing economy and persistent inflation. They'll have to choose. Do they save the economy and let inflation run? Or do they fight inflation and let the economy crash? There's no good choice. This is the trap. This is why the Fed pause is so dangerous. It sets up a dynamic where moral hazard returns, speculation returns, bubbles form again, but the Fed won't have the tools to rescue markets when those bubbles burst. Fourth, the Fed is losing control of the narrative and credibility. And in central banking, credibility is everything. Central banking is as much about psychology as it is about economics. Maybe more. The Fed's power comes not just from setting interest rates, but from managing expectations, from influencing how people think about the future. If the Fed says they're committed to bringing inflation down to 2%, and markets believe them, and businesses believe them, and workers believe them, then inflation expectations stay anchored. Everyone makes decisions based on the assumption that inflation will be 2%. Businesses don't raise prices as aggressively because they believe inflation is temporary. Workers don't demand huge wage increases because they believe their purchasing power will be protected. Bond investors don't demand higher yields because they believe inflation will come back down. The Fed's credibility reinforces the policy outcome they want. It's a virtuous cycle. But if the Fed loses credibility, if markets stop believing them, if businesses and workers stop trusting that inflation will come down, then expectations become unanchored. People start to assume inflation will stay elevated. And that becomes self-fulfilling. Businesses raise prices preemptively to protect their margins. Workers demand cost of living increases to maintain their purchasing power. Bond investors demand higher yields to compensate for inflation. And actual inflation stays high or goes higher. It becomes baked into the system. And it becomes much harder to control. You need even more aggressive rate hikes, even more economic pain, even higher unemployment to break the psychology. The Fed has already damaged their credibility, badly. They said inflation was transitory in 2021 when anyone looking at the data could see it wasn't. They kept rates at zero and kept buying bonds even as inflation was clearly accelerating. They were way too slow to start raising rates. They've been consistently behind the curve. They've been reactive rather than proactive. They've made excuses rather than taking responsibility. Now they're signaling that they might pause or even cut rates soon. But inflation is still double their target. It's still at 4% when they want 2%. What message does this send? It sends the message that the Fed is more concerned about the stock market and the economy than they are about inflation. It sends the message that 2% inflation isn't really their target. That they'll accept 3 or 3.5 or 4% if pushing for 2% requires too much economic pain. It sends the message that the Fed doesn't have the stomach for the fight, that they're going to declare victory prematurely, that they're going to back down when things get tough. This is incredibly dangerous. Because once inflation expectations become unanchored, once people start to believe that inflation is going to stay elevated, it becomes incredibly difficult to bring it back down. You have to prove through actions that you're serious. You have to do whatever it takes, no matter how painful. And breaking that psychology requires even more aggressive rate hikes and even more economic pain than if they just stayed committed in the first place. If they just kept their foot on the brake until inflation actually hit 2%. I've studied the history of central banking extensively. I've read about the great inflation of the 1970s in detail. I've read about the Volcker shock. I've read about the mistakes central banks made in Germany in the 1920s that led to hyperinflation. In Argentina, that had repeated inflation crises. In Zimbabwe, that printed their currency into worthlessness. The pattern is always the same. Central banks that lose credibility, that are seen as politically captured or weak-willed, that cave to pressure from politicians or markets, they lose control of inflation. And regaining control requires draconian measures. Volcker had to push interest rates to 20%. He had to endure enormous political pressure. President Reagan's advisors wanted him fired. The construction industry put 2x4s outside Fed buildings in protest. Farmers drove tractors to Washington. The unemployment rate hit 10.8%. But Volcker didn't budge. He kept rates high until inflation was broken. And because he did, because he showed that the Fed would do whatever it takes, He restored the Fed's credibility. Inflation expectations became re-anchored at low levels, and we had 2 decades of low inflation and steady growth. The Fed is dangerously close to losing credibility again. If they pause now, if they signal that they're not really committed to getting inflation back to 2%, if they show that they'll back down when markets complain or when the economy shows signs of weakness, they might lose the confidence of markets and the public. And once that's lost, it's very hard to get back. It takes years of proving yourself. And in the meantime, you get persistently high inflation or stagflation or crisis. Fifth, and this is what really keeps me up at night, there are hidden leverage and fragilities in the financial system that haven't been exposed yet. We don't know where all the bodies are buried. The financial system is vastly more complex and interconnected than it was in 2008. We have shadow banking, we have derivatives markets that dwarf the size of the underlying real economy. The notional value of derivatives outstanding globally is over $600 trillion. That's more than 6 times global GDP. We have algorithmic trading and high-frequency trading that can amplify market moves and create flash crashes. We have private credit markets that operate with minimal regulation or transparency. We have cryptocurrency and decentralized finance with unknown interconnections to traditional finance. All of these create potential points of failure. Leverage hidden in complex structures. Counterparty risks that aren't obvious. Feedback loops that can amplify small shocks into system-wide crises. And we don't know where the weaknesses are until something breaks. That's always how it works. In 2008, the failure point was subprime mortgages and the derivatives tied to them. Collateralized debt obligations, CDOs, credit default swaps. Most people had never heard of these things before the crisis. The system didn't understand how exposed it was until Lehman Brothers failed and suddenly credit markets froze. Banks didn't want to lend to each other because nobody knew who had exposure to bad mortgages. The whole system seized up. What's the failure point this time? I don't know for certain. Nobody does until it breaks. But I have suspicions. I have areas I'm watching closely. One possibility is interest rate derivatives. There are hundreds of trillions of dollars in interest rate swaps and other derivatives outstanding. These are contracts where 2 parties exchange cash flows based on interest rates. They were used heavily during the zero interest rate era to manage risk and enhance returns. But rates have moved dramatically over the past 2 years. Someone is on the wrong side of those trades. Someone has massive unrealized losses. When rates go from 0 to 5%, the value of interest rate derivatives changes dramatically. Some positions make money, some positions lose money. And when the losses are big enough, they can wipe out institutions. We saw a preview of this in the UK in September of 2022. When the new UK government under Liz Truss announced a large fiscal stimulus package, bond markets freaked out. UK gilt yields spiked. This created massive losses for UK pension funds that had used derivatives called liability-driven investments to hedge their pension obligations. The losses triggered margin calls. The pension funds had to post more collateral. They didn't have enough cash. They had to start selling gilts to raise cash. This pushed gilt yields even higher, which created more losses, which triggered more margin calls. It was a doom loop. The Bank of England had to intervene and buy gilts to stop the spiral. They had to backstop the market to prevent a complete meltdown of the UK pension system. And that was just in one relatively small market, the UK gilt market. Imagine if something similar happens in the US Treasury market. The Treasury market is the foundation of the global financial system. It's the largest and most liquid bond market in the world. Everybody uses treasuries as collateral. Everybody prices risk off treasury yields. If the Treasury market breaks, if yields spike suddenly and violently, if liquidity disappears, everything breaks. The entire global financial system could seize up, and we don't know what could trigger it. Maybe it's a wave of selling as the government issues more and more debt to fund deficits. Maybe it's foreign buyers pulling back. Maybe it's hidden leverage in the financial system getting unwound. We won't know until it happens. Another possibility is private credit. In the era of zero interest rates, huge amounts of money flowed into private credit funds. These are funds that lend to companies outside of traditional banks. They offer higher yields than safe bonds, but with much less transparency and liquidity than public debt markets. investors liked the higher yields. And they liked that private credit was marked at par, meaning the loans were always valued at full price on statements, unlike public bonds that fluctuate with market prices. But that stability is an illusion. These funds have grown to over $1.5 trillion. That's an enormous amount of capital. And we have no idea what the real credit quality of their loan portfolios actually is. Because they're private, they're not subject to the same disclosure requirements as public markets. In many cases, the loans are to highly leveraged companies, companies with weak cash flows, zombie companies that are fine when rates are low but can't survive with higher rates. And rates have gone up dramatically. So some of these companies are starting to default. The private credit funds are taking losses. But because these funds are illiquid, because they don't mark to market like public bonds, because investors can't easily withdraw their money, the losses are hidden. They're building up beneath the surface, and at some point, it's going to break through. We could see a wave of redemption requests that forces these funds to actually value their loans and realize they're worth much less than par. That would cause massive losses for investors. Or we could see a wave of defaults that overwhelms the fund's ability to absorb losses. Either way, when the losses become visible, it could trigger contagion. Investors could pull back from all forms of credit. Credit spreads could blow out. Companies that depend on access to credit could suddenly find themselves unable to refinance. And that would spread to the broader economy. Cryptocurrency is another potential point of failure. The crypto market has already collapsed once in 2022. Bitcoin fell from 69,000 to 16,000. The total crypto market cap fell from 3 trillion to under 1 trillion. Many crypto companies went bankrupt. FTX, a major exchange, collapsed spectacularly due to fraud. Celsius Network, a crypto lender, went bankrupt. Voyager Digital went bankrupt. Three Arrows Capital, a major crypto hedge fund, blew up. But there's still a lot of leverage in the system. There are still enormous amounts of crypto assets held by various institutions. Some hedge funds, some family offices, some publicly traded companies have significant crypto holdings on their balance sheets. If we get another leg down in crypto prices, if Bitcoin falls to 10,000 or 5,000, more institutions will face losses. Some will fail. And some of those institutions might be connected to traditional finance in ways we don't fully understand. Maybe they borrowed from banks to fund their crypto investments. Maybe they use crypto as collateral for traditional loans. We don't know because crypto operates in the shadows of regulation. The key point is this. When the Fed raises rates from 0 to 5% in less than 2 years, when they remove all that liquidity from the system, when they make money expensive after a decade of making it free, something is going to break. The system has too much leverage. There are too many hidden risks. There are too many interconnections we don't understand. We just don't know what will break until it does. And if the Fed pauses too soon, if they give the system a false sense of security, if they signal that the coast is clear and risk is back on, it sets us up for an even bigger crash when the fragility is finally exposed. Because more leverage will get piled on, more risk will be taken, and when it breaks, it will be bigger and more violent than if we just let the system delever gradually under sustained tight monetary policy. Now, let me connect all of this together to explain exactly how the Fed pause could crash everything. Let me walk you through the scenario step by step so you can see how this unfolds. Here's what I think is going to happen. The Fed pauses rate hikes. They've already signaled this. They're on pause now in late 2025. They're holding rates steady around 5%. Markets rally. The S&P 500 goes to new all-time highs. Corporate bonds rally. Credit spreads tighten. Junk bond yields come down. Everyone breathes a sigh of relief. The financial media declares victory. Headlines say, Fed achieves soft landing. Inflation falls without recession. Goldilocks economy continues. Investors pile back into risk assets. Stocks, corporate bonds, private equity, everything. They think the danger has passed. The consensus becomes that we've threaded the needle. Inflation is falling gradually back to 2%. The economy is slowing, but not crashing. GDP growth is positive but modest. Unemployment stays low. The Fed will probably start cutting rates in late 2026 or early 2027 once inflation gets closer to 2%. Everything is fine. Everyone is happy. But underneath the surface, problems are building. The lag effects of the rate hikes are hitting. Commercial real estate defaults are accelerating. Office buildings are being handed back to lenders. Retail properties are struggling. Regional banks are taking losses on their loan portfolios. They're trying to hide it. They're extending and pretending, modifying loan terms, extending maturities. Anything to avoid recognizing the losses. But the losses are real and they're growing. Corporate bankruptcies are rising. Highly leveraged companies can't refinance their debt at the new higher rates. Some are defaulting. Some are doing distressed debt exchanges. Private equity-owned companies are struggling because they were bought at peak valuations using cheap debt. Now, the debt is expensive and the companies can't generate enough cash flow to service it. The lag effects of the Fed's rate hikes are hitting the economy hard. Unemployment starts to tick up from 3.7% to 4% to 4.5%. Not a huge increase, but noticeable. GDP growth slows. Maybe we have a quarter or two of slightly negative growth. Consumer spending weakens. People are pulling back because their savings are depleted and wages aren't keeping up with even 3% inflation. But here's the key. Inflation doesn't keep falling. This is critical. Inflation stalls out at 3 or 3.5%. It won't go down to 2% because the structural drivers I talked about earlier are keeping it elevated. The tight labor market, deglobalization, energy constraints, government spending, wage price inflation. All of these factors keep inflation above 3%. The Fed looks at the data over 6 or 9 months and realizes they made a mistake. They paused too soon. Inflation isn't returning to target, it's stuck. The last mile from 3% to 2% is the hardest, and they're not making progress. But now the economy is weakening. Unemployment is rising. Growth is slowing. They're stuck in the worst possible position. If they restart rate hikes to finish the job on inflation, they'll push the economy into a deep recession. Unemployment will spike. Maybe it goes to 6 or 7 or 8%. That's politically unacceptable. If they start cutting rates to support the economy, they'll signal that they're giving up on 2% inflation. They'll reignite inflation expectations. Inflation might accelerate back to 4 or 5 or 6%, and then they'll have to raise rates even more aggressively later. While the Fed is paralyzed trying to figure out what to do, while they're debating and issuing conflicting statements, one of those hidden fragilities I talked about gets exposed. Something breaks. Maybe it's a major private credit fund that suddenly has to mark down their loan portfolio by 30% and gates redemptions. Investors can't get their money out. Panic spreads to other private credit funds. Redemption requests flood in. Maybe it's a large regional bank that fails due to commercial real estate losses. Bigger than Silicon Valley Bank. Maybe it's 50 or 100 billion in assets. The FDIC has to step in. Depositors get nervous about other regional banks. Uninsured deposits start fleeing. Maybe it's an interest rate derivative blow-up at a major institution, a large hedge fund or family office or insurance company. They have massive losses on interest rate swaps. They can't meet their margin calls. They have to liquidate positions. This creates forced selling across markets. Whatever it is, it creates a shock. Markets realize that the system is more fragile than they thought. Risk appetite disappears instantly. Investors rush for the exits. Stock prices start falling. Credit spreads blow out. Junk bond spreads go from 400 basis points to 800 to 1200. Companies that need to refinance debt find that they can't. The cost is too high or there are no willing lenders. Credit markets are freezing up. More companies default. This creates losses for lenders. Banks and credit funds and bond investors. They all take losses, and they start to pull back. They reduce lending. They tighten standards dramatically. They refuse to lend to any company that looks even slightly risky. Credit conditions across the economy deteriorate rapidly. This hits the real economy. Small businesses can't get loans to fund operations. They have to lay off workers. Real estate transactions can't get financed. Construction projects get canceled. Companies cut investment spending. They lay off workers. Unemployment rises faster, from 4.5% to 5.5 to 6.5. Consumer spending falls hard. People who lose their jobs obviously spend less. People who still have jobs but are worried they might lose them also spend less. They save more. They pay down debt. They pull back. Corporate profits fall. Companies that were barely profitable become unprofitable. More companies cut costs. More layoffs. Stock prices crash. The S&P 500 falls 20%, then 30%, then 40%. The Nasdaq falls even more. Tech stocks and unprofitable growth companies get absolutely crushed. Retirement accounts get decimated. Trillions of dollars of wealth disappears. The crash feeds on itself. Falling stock prices destroy wealth. This makes consumers pull back more, which causes corporate profits to fall more, which causes more layoffs, which causes more pullback. It's a negative feedback loop, a doom loop, a death spiral. Meanwhile, the Fed is faced with a nightmare scenario. The economy is crashing, markets are in free fall, unemployment is spiking, but inflation is still at 3 or 3.5%, still well above their 2% target. What do? If they cut rates aggressively to support markets and the economy, they risk reigniting inflation. They risk completely destroying what little credibility they have left. They risk creating a situation where inflation expectations become permanently unanchored. And then they'll have to do a Volcker-style shock later with even more pain. If they hold rates steady or even raise them to prove they're still committed to fighting inflation, they let the crash continue. Maybe they cause a depression. Unemployment goes to 8 or 9 or 10%. The political pressure becomes unbearable. There's no good choice. They're trapped. And it's their own fault for pausing too soon. This is the trap the Fed has walked into. They've given markets false hope. They've encouraged risk-taking by pausing. They've let fragilities build by not maintaining pressure. And now, when reality hits, when the lag effects come through, when something breaks, the crash will be worse than if they just stayed aggressive on rates and let asset prices adjust gradually to a higher rate environment. This scenario is not certain. I'm not saying it's definitely going to happen exactly like this, but I'm saying the probability is much higher than markets are pricing in. Markets are currently priced for perfection. They're priced for a soft landing where inflation falls smoothly to 2%, the economy stays strong, unemployment stays low, and the Fed cuts rates. That's a very narrow path. That requires everything to go right. And based on history, based on the lag effects of monetary policy, based on the structural nature of current inflation, based on the hidden leverage in the system, I think the probability of that perfect outcome is very low, maybe 10 or 20%. The much more likely outcome, in my view, 60 or 70% probability, is that the Fed has to choose between recession and inflation, that they get stuck in the trap I described. And whatever they choose, markets are going to be disappointed and reprice violently. So what should you do? How do you protect yourself? How do you position for this scenario? I'm going to give you specific, actionable advice. This isn't theoretical. This is what I'm actually doing with my own money. First, understand that we're in a very dangerous period. The next 6 to 18 months are going to be critical. The Fed's decisions, how inflation evolves, what breaks in the financial system, all of this will determine whether we have a controlled slowdown or a catastrophic crash. Don't be complacent. Don't assume that just because markets rallied that everything is fine. The rally might be setting up the crash. Be prepared for extreme volatility. Be prepared for the possibility that markets give back all their gains from the past year and then some. The S&P 500 could easily fall 30 or 40% from current levels if the scenario I described plays out. Second, and I can't stress this enough, be very careful about taking on leverage. This is not the time to be buying stocks on margin. This is not the time to be taking out loans to invest. This is not the time to be stretching yourself financially. Leverage amplifies gains, but it also amplifies losses. In a crash, leverage can wipe you out completely. It can force you to sell at the worst possible time. It can destroy decades of wealth accumulation in weeks. Keep your personal debt levels manageable. Make sure you can service your debts even if your income falls by 20 or 30%. Make sure you're not dependent on refinancing at low rates, because rates might stay high for years. Build a cushion. Build margin of safety. Third, hold more cash than you normally would. I know cash feels like a terrible investment right now. Inflation is 3 or 4%. You're losing purchasing power sitting in cash. But cash gives you optionality. Cash gives you flexibility. Cash lets you survive a crash without being forced to sell assets at depressed prices. Cash lets you buy assets when everyone else is forced to sell and prices are at generational lows. The best opportunities come during crashes. The best investments I ever made were during the 2008 crisis when everything was on sale and nobody had capital to deploy, but only if you have cash available. I'm holding significant cash right now, much more than I normally would, 20 or 30% of my liquid net worth. I'm willing to accept the inflation erosion because I think the opportunity cost of not having dry powder when the crash comes is much higher. Fourth, if you own stocks, focus ruthlessly on quality. This is not the time for speculation. This is not the time for unprofitable growth companies. This is not the time for companies dependent on easy credit. Own companies with fortress balance sheets, minimal debt, strong free cash flow generation, real earnings, not adjusted EBITDA or non-GAAP earnings, but actual GAAP net income. Own companies with competitive advantages, with moats that protect them from competition. Own companies that can survive a recession and come out stronger. Think Berkshire Hathaway. Think Microsoft. Think Coca-Cola. Think Procter & Gamble. Avoid unprofitable growth companies entirely. Avoid companies with high debt loads. Avoid companies in sectors that are vulnerable to higher rates, like commercial real estate, home building, highly leveraged industrials. Those companies will get destroyed. Fifth, be very careful with bonds. Long-duration bonds are extremely risky right now. If inflation stays at 3 or 4%, if the Fed has to restart rate hikes, long-duration treasury bonds will get crushed. A 20 or 30-year treasury could easily lose another 20 or 30% of value if yields spike. Even short-duration bonds have significant risk. If we have a wave of corporate defaults, corporate bonds will get hit hard. Investment-grade bonds could face downgrades. Junk bonds will see massive defaults. I'm avoiding long-duration bonds entirely. I prefer to hold treasury bills, very short duration, 1 to 3 months. They're very safe. They yield around 5%. That's competitive with what you'd get taking significantly more risk in corporate bonds or longer duration treasuries. And if we do get a crash and the Fed is forced to cut rates, I can redeploy that cash into longer duration bonds at higher yields or into stocks at lower prices. Sixth, consider alternative assets that perform well in inflationary or crisis scenarios. Gold is the classic inflation hedge. It tends to do well when confidence in central banks declines. When people worry about currency debasement, when inflation is persistently above target, I'm not a huge gold bug. I don't think you should put your whole portfolio in gold. But having 5 or 10% makes sense as insurance. Real assets also make sense in an inflationary environment. Things like farmland, timberland, energy infrastructure, commodities, these tend to hold value or appreciate when inflation is elevated. They're real things with intrinsic value. They can't be printed by central banks. Energy in particular looks attractive. Oil and gas companies are generating massive free cash flow. They're returning cash to shareholders through dividends and buybacks. And they're trading at reasonable valuations. If inflation stays elevated, energy will continue to do well. Seventh, if you're sophisticated enough and understand the risks, consider hedging strategies. This isn't for everyone. But if you have a large portfolio and you understand options, puts on broad market indexes can provide insurance. Buying put options on the S&P 500 or the NASDAQ. If the market crashes, these puts will increase dramatically in value and offset losses in your long positions. Inverse ETFs are another option. These are funds that go up when the market goes down. But be careful with these. They're designed for short-term trading. They don't work well if held for long periods due to daily rebalancing. Short positions in specific weak companies or sectors can also work. But shorting is risky. Timing is difficult. You can be right about the direction but wrong about the timing and lose money. Only do this if you really understand what you're doing. Eighth, stay informed and be ready to act quickly. We live in an era where things move fast. Bank runs happen in hours. Market crashes happen in days. You can't be asleep at the wheel. Follow the Fed's statements carefully. Watch inflation data releases. Watch employment data. Watch credit markets. Watch corporate bond spreads. If spreads are widening, that's a warning sign. If junk bond yields are spiking, that means credit stress. Watch for signs of stress in the banking system. Are banks reporting losses? Are deposit outflows accelerating? Are any bank stock prices collapsing? These will be early warning signs. The warning signs will be there if you're looking for them, but you have to actually look. You can't just check your portfolio once a quarter. And finally, don't panic, but do prepare. There's a big difference. Panic is reactive and emotional. It's selling everything at the bottom because you're scared. Preparation is proactive and rational. It's positioning your portfolio defensively before the crash happens. I'm not telling you to sell everything and hide in a bunker. I'm telling you to think through the scenarios, to position your portfolio so that if the crash comes, you'll be okay. You'll survive. You'll be able to take advantage of opportunities. If you're prepared, if you've followed the steps I outlined, you'll be able to act calmly when everyone else is panicking. You'll be able to deploy cash when assets are at fire sale prices. You'll be able to protect your wealth and potentially grow it during the crisis. That's what I did in 2008. I wasn't lucky. I was prepared. I understood what was happening. I had positioned correctly. I had shorted subprime mortgages when everyone said I was crazy. And when the crash came, I made over 700% returns, while most investors lost half their net worth. I'm preparing again now, because I see the same patterns, the same mistakes, the same dangerous assumptions, the same building fragilities. And I see the Fed making policy errors that will make everything worse. The Fed pause is not good news. It's not a signal that everything is fine. It's not time to celebrate and pile into risk assets. It's a signal that the Fed is giving up the fight against inflation too soon. It's a signal that they're more worried about market prices than about their actual mandate of price stability. And it's setting us up for a crash that could be devastating. I could be wrong. I'm always willing to admit that. Maybe the Fed will nail the soft landing. Maybe inflation will magically fall to 2% without any more pain. Maybe the economy will stay strong. Maybe all the hidden leverage will unwind smoothly. Maybe nothing will break. But I wouldn't bet on it. And I'm not betting on it with my own money. I'm preparing for the alternative scenario, the one where the Fed's pause turns out to be a catastrophic mistake. The one where markets crash because reality doesn't match the optimistic assumptions. The one where the lag effects of rate hikes hit harder than expected. The one where inflation proves stickier than the Fed expects. The one where something breaks in the financial system and reveals fragilities that nobody knew existed or wanted to acknowledge. That's the scenario I'm positioning for. Because the downside of being wrong, the downside of preparing for a crash that doesn't happen, is that I hold too much cash and miss some gains. That's acceptable. I can live with that. The downside of not preparing, the downside of being complacent and getting caught in a crash, is losing 30 or 40 or 50% of your wealth, maybe more. That's not acceptable. I can't live with that. I'll take the first risk over the second any day. You should think seriously about doing the same.